Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host. Thanks so much for tuning in, everybody. I'm flying solo without Brian London today, but you can get his top 2 mining stock picks and access to golden opportunities. That's his other newsletter. And you go to goldnewsletter.com/bonus and you can get Brian's insights. Our guest today is Joe Mazumdar. He is a specialist in junior mining exploration. He's the editor of Exploration Insights, where he has been since December 2015, so just over 4 years. Prior to that, he was a senior mining analyst at Haywood Securities, then Canaccord Genuity, and his work experience includes strategic planning, corporate development at Newmont, and further analysis and trading with Phelps Dodge. Whew. Okay, Joe, welcome back to Gold Newsletter.
No worries. Thank you. You missed about 10 years of exploration work as well.
But well, mate, we try to keep these bios concise, but yeah, they can get a bit to read. We want to get straight to the action. And yeah, Joe, you've been on the show before, and I remember the first time you were on, you were teaching me, I guess, the lingo, because I was just getting involved with the podcast. The GDXJ was the one you mentioned, one of these mining ETFs, and I was going, what is this GDXJ business? So it's really fresh. But so I saw a recent presentation from you at the Metals Investor Forum in January, so recently, and you were discussing the investment clock. As far as I can tell, it was this cycle between a bloated sector with everyone jumping on the bandwagon and then a scaled back or gutted sector. Is that a correct description? And if so, where is the mining sector at this stage?
Well, thanks for having me. Yeah, it is basically a clock made by a combination of Lion Selection One and Investec about basically trying to track our cyclical industry. So each one of these clocks can be used for each metal or resource, going from a plunging sector where there's probably a market capitulation on the price, which happened with gold a few years ago, and then the impact on companies, to cut costs, write-downs, dropping your reserves, amassing very high debt burdens and not making a lot of money and being forced to cut your dividends. But we've gone through all of that, especially in the gold sector, as we look maybe at the last year or two with companies like Barrick Gold and Newmont. And what we've seen over this last, let's say, year is this trend for them to divest, make money, and then resolve their high debt burdens. And as the market is recovering in the gold price, on the other side, with the junior sector, we've seen a bit of a recapitalization. Not huge with respect to last decade, but something that gives it a bit of a heartbeat. And we've seen M&A. But the M&A mostly that we've seen is from the Australian sector, which has been making money with a higher Australian dollar gold price, generating free cash flow, and then coming over to the Americas and purchasing assets. So in terms of M&A right now, looks like we're in the buy mode with respect to the clock.
I see. And why do you think there is this tendency for the sector to be just so cyclical? Why is there this up and down? Why are we just all irrational? What's going on?
Well, these resource sectors require a lot of capital, and there's long lead times to build projects. And so you raise the capital, you build the project, but underlying that, the price that you're selling at can be very volatile. And such that if you book the reserve at $1,500 gold, which was the price we were using previously back in, let's say, 2014, 2015, and then you bring the project into production or are trying to develop it, and then the gold price is $1,100, you're not going to make a lot of money. And you're definitely not going to make enough money to pay back your debt. And so then you amass debt, you're limited free cash flow, and basically you can't pay dividends. And then you have to wait for the market to turn in terms of the gold price, which it has. But the discipline that some of the gold mining companies are showing now is trying to keep the reserve price low, keep it at $1,250, $1,200, even if the gold price is $1,500, $1,600. That way, you know the projects that you have and call reserves are actually going to make you money. And so I think that's a new discipline that's coming. I don't know how long it's going to last. But what we do know is that the generalist investor is really less preoccupied probably with growth in production, which was what the investors were searching for when they looked for gold companies over the past decade. Now they're really looking for stable dividends. And looking at this type of generalists, these major gold companies are thinking like, if I can have a decent gold production profile that generates free cash flow and I can assure dividend payments, I can compete with the ETFs that have basically taken over the investment.
It reminds me a little bit of, I'm here in Houston, it reminds me a little bit of the energy sector. And I went to a presentation just in the last couple of weeks with a major investment banker saying how there was just such a huge urge for growth of production, let's say without concern for the underlying viability of each project. And that is scaling back a lot right now. So maybe there's some comparison there, but your personal view or assessment is that both juniors and I guess larger mining companies are being more conservative and maybe mitigating somewhat the instability of the sector?
I wouldn't say juniors. I would say the producers, because they are facing these investors.
Okay.
And they're not competing against other companies now. They're competing against that GDXJ or the GDX
Right.
or other ETFs that are dominating the sector with respect to investments. And these ETFs do not provide the market or companies with money. They do not do private placements. They don't not raise equity. They just buy shares and provide you liquidity. So a lot of the institutional equity now really doesn't exist because their underlying investors have left and have now invested in ETFs, which come with cheaper fees.
Yeah.
So the fee structure is different, and so they invest in them, and it's hard for a lot of these institutional equity investors to basically year on year beat the ETF consistently and justify the fee. And so a lot of that money has gone into ETFs, not only in the gold sector, probably in all sectors, and it's also in the gold sector as well. And so definitely with the major companies, part of the mega merger and the consolidation that we're seeing with the majors that we saw last year, and now with the mid-tier producers that we're seeing trying to grow, that's all a part of trying to increase your capital profile to get noticed.
That is an interesting point because, of course, the rise of ETFs has been huge, but I did not think that it would apply so much to the mining sector just because the returns to different projects are so variable. And so that assumed that there would be much more value in doing the fundamental research or fundamental analysis. So do you want to speak about the merits to investors and going, I guess, working with people like you and getting your insights versus going with the ETFs?
Well, the thing is with the ETF, you are getting, a bunch of companies. You're getting, they're all liquid, they're all solvent, and that's what the ETF needs, because all they need to do is basically have an index and try to emulate it. But if it's not liquid, they can't do it. So they can't do juniors. And they tried that when they started with the GDX. They tried to do non-cash flowing development companies and explorers at that time that had more liquidity and had higher market caps. But when the market went the other way, the liquidity dried up, and they couldn't hold them anymore. So a lot of the GDXJ, which is the smaller fund, many of the companies that the GDXJ holds are the same companies that are in the bigger fund, in the GDX. So the issue for them is they can't hold the development companies. They can't hold a lot of the junior producers, and they definitely cannot hold the junior explorers. And so there's not too many companies that I hold or I talk about, except from trying to get an industry perspective that we actually buy in the portfolio that would be on the GDX or the GDXJ. We deal a lot more with juniors. We deal a lot more with developers, and a lot more with non-cash flowing companies versus the cash flowing companies that the GDX and the GDXJ would have.
The Gold Newsletter podcast is proudly sponsored by the Discovery Group of Exploration and Development Companies. To learn more about our exceptional track record and exciting future, visit discoverygroup.ca.
Hello, listeners. Welcome to our weekly interview with the Discovery Group. As you all know, each week we interview one of the Discovery Group companies. I am Daniel Duarte, editor of this podcast, and today I have the pleasure of talking again with Claudia Tornquist. She is president and CEO of Dunnedin Ventures, or should I say Kodiak Copper. Have you made the name change already? What's the story, Claudia?
Thank you, Daniel. Thanks for having me. Yes, as you said, we will change the name of our company to Kodiak Copper Corp. And that's really the last step in our transition from a diamond explorer to a copper explorer. Over the last year and a bit, we changed the focus of our company. We acquired 2 copper exploration projects, MPD in southern British Columbia and Mojave in Arizona, and are now focused on our portfolio of 3 copper porphyry exploration projects. We started exploring drilling last year in November, had some really nice results, a great discovery hole in January. So now it's full steam ahead on the copper side, and the new name Kodiak Copper marks this strategic transition.
Well, it seems you have been very active this year so far.
Well, we released our exploration results where we had a nice discovery hole at the MPD project in southern BC. And then on the back of those results, we are now raising $3 million, are in the final stages of it, which will fund a follow-up program to follow up on the good initial results, and then will also be used for an initial drill program at our Mojave project in Arizona, which is the second project on our list and has just as much discovery potential as MPD.
So you mentioned you are going to focus now on copper. What are your priorities for 2020?
It'll be a very busy year for us, 2020. As I said, last year, 2019, was a year of transition. And now we are very well positioned with our portfolio of copper projects, and we will drill 2 of those projects, MPD and Mojave. So there will be new drill results over the summer and over the autumn. And both of these projects are in very good locations where we can drill year round. So lots of news to come.
You have just returned from PDAC in Toronto, which is the world's largest mining conference. What can you tell us about the sentiment in the industry? Is the spread of the coronavirus across the globe disrupting mineral supply chains as well?
You could certainly, at the trade show, see the impact and feel the impact of the coronavirus a little bit. The sentiment was probably less optimistic than in other years, or that it would have otherwise been. On the other hand, I heard a talk of the Chilean mining minister, who was very optimistic that copper would rebound to the $3 per pound range once the coronavirus scare is over. And in his view, that was only a question of 1 or 2 or 3 months, like we saw when the SARS epidemic took place a couple of years back. So, hopefully we'll get over this corona scare relatively quickly, and then onwards from there.
Yes, these are encouraging news indeed. Claudia, thank you so much for your time today and for updating us on Dunnedin Ventures, Kodiak Copper, and its opportunities.
Thank you, Daniel.
And one thing interesting from your presentation, which you gave last month, was that I think it was the GDXJ you were referring to has had just a terrible record over the last 10 or 20 years.
The thing is that with the GDX or the GDXJ, I mean, it provides you leverage with the underlying gold price.
Yes.
And that's basically what the investor's looking for. And so as long as the reason you invest in an ETF is that you have an index and it can emulate it. That's the task of the person running the ETF, is to emulate that index as best as they can. And that's what they get a fee for. Whether it goes up or down, that's not the point. It's that you stay within a range of where that index would naturally trade. Whether it's done well or badly, that's neither here or there. That depends on the companies underlying it. And you would buy an ETF knowing that. If the GDX is not doing well, that's a function of the companies in the GDX not doing well, not performing well. But what we've seen, to your point, last year, is that even though we saw the gold price coming up, from $1,250 to now almost $1,600, probably back and forth, is that GLD, which is the gold ETF, started much earlier. That started at the end of May, obviously with the gold price, but it took till September till the market, the equities, saw more investing. So it took like about several months of the gold price going up before they believed it, basically, and then decided to start investing even into the ETFs and not necessarily into the companies directly.
But what is the natural order there between the gold price or gold ETF going up, going to the mining ETFs, and then to the actual mining companies themselves? Is it a natural sequential order?
Yeah, there's definitely lag. So if you were bullish on gold, the ETFs is a reflection of what's happening in the companies. But the issue right now is that the generalist prefers the ETF than trying to study every company in the GDX. They don't want to do all that homework. They don't care. They just want equity exposure to gold. And somebody that gives me diversified equity exposure to gold, that's the one I'm going to invest in. And now I'm picking which ETF makes the most sense for me with respect to fees and performance. Because I do not want to look at Newmont's balance sheet, or I don't care about Barrick's issues in Chile. I don't want to deal with that. So that's why I would invest in an ETF. But if I want to step back and say, okay, I'm going to do a little bit more homework, look at the GDX or the GDXJ and say, which of these companies are actually the best performers, and just pick those. I want to cherry pick that. That takes more work, but the potential is for higher returns, because then you don't pick a lot of the laggards that you think from your fundamental analysis that you've delineated. That would be the next step. And that's why the Barricks and the Newmonts and all these other companies are trying to show their best foot forward, because one thing the ETF cannot offer is the dividend. So if you can offer that same exposure to gold, that same beta to gold, but also offer dividends, you offer liquidity, solvency, you don't need money, then that could be attractive to the generalist investor. And I think that's what a lot of the big companies are doing. They're not as focused on growth, but they know that their pipelines have to produce quality assets, and that needs exploration. But their exploration programs are picking up, but also they realize that they need to use juniors to help them with respect to exploration to find those tier one assets, those long-lived, low-cost assets that would help them generate that long-term free cash flow that can give you sustainable dividends. That's basically where they're at right now.
Yeah, and you divide your investment clock into three portions: the look, the buy, and the sell. And just to confirm, you believe that you should have already done your looking and you're in the buy stage when the mergers and acquisitions and then the new IPOs?
Yeah, I mean, this clock is not mine. I was trying to actually look at this clock and see where we were by looking at certain gold companies like Barrick and Newmont to see where we were in that clock in the industry overall. I mean, it's not like a tick by tick resolution with respect to how we are in the industry, because I've seen some things that are happening ahead of it that say that we might be at a sell position, and other places that we should be in a look position. But the M&A is there because the companies know that they don't have a pipeline, because over the last few years they've been more focused on generating free cash flow, eliminating debt, and just hunkering down. Now they have to think, okay, I'm going to divest assets that are basically orphaned. They don't generate a lot of my valuation, and they're very high cost. And maybe it's better if another company has it that they could make, turn it around. Hence, a lot of the M&A that we saw were divestments from big companies purchased by mid-tiers. And so for the investor, like who's looking for a development plan and said, okay, that's going to get bought out, that's competing directly against these divestment assets that are coming out. You're not going to make much money on Barrick divesting the Kalgoorlie Consolidated Gold Mines in Western Australia. You're not going to get money made from Newmont divesting Red Lake in Northern Ontario. So we're not seeing a lot of that. Like, we're not seeing that M&A premium. That's the other thing we're not seeing. We're not seeing the big 35 to 50% premiums now. Now a lot of the M&A is at a very low premium, forcing the individual junior company to add the value, as opposed to waiting for someone just to buy them out, because it's very suitor specific now with respect to the M&A, and it's the individual company has to add a lot more value than they did in the last cycle.
Sure. And you said that there has been a spanner thrown into the works since you gave the presentation, and that was this coronavirus.
Right, yeah.
This has maybe different impacts on different whether you're referring to precious metals and you said other mining projects. Do you want to clarify?
Right. I mean, so the coronavirus, as probably your listeners are well aware, is this now called the COVID-19 that basically started maybe in late 2019 in the Hubei province in China, and now it's developing into what the World Health Organization will probably deem a pandemic in the next few weeks. I mean, it's not as fatal, I believe, as the SARS virus, but it's much more contagious. And getting aside the intricacies of the virus, which I probably won't be much help with, but I'm just looking at the impacts of it, slowing down the Chinese economy and freight industry, industrial production in the second largest economy in the world, but also now it's spreading into Korea, and it's already in Italy and some other countries. The point is that China is still the biggest consumer of most of the industrial metals. And so the volatility in the market right now that the coronavirus is generating, which has, the VIX basically spiking up and down and drawing people out of the equity markets, has pushed people into safe haven assets like gold. So that's actually been a positive for gold, and part of the reason that gold has come up to about 1,600. But the underlying medium, long-term thesis for gold, or my thesis for gold, remains like too much negative yielding debt. And in a negative yielding environment, something that yields zero is actually a positive. So gold works long term. But now in the near term, it's being positively impacted by the coronavirus. On the other side, the other kind of metals that I'm invested in are, for this, potential limitation of greenhouse gas emissions. And so those are the battery metals. So the copper, the nickel, palladium with respect to emissions, lithium, those sort of metals, those industrial metals. If cars are not being made in China, then they don't need as much copper, and then they don't need as much of some of these metals, So that's in the near term impacting those metals negatively. My long-term thesis and why I hold these stocks remains, but in the near term, that's been a definite negative on those metals.
Right. Okay. Joe Mazumdar's website is explorationinsights.com, and he's got a YouTube channel. He's on LinkedIn and on Twitter. Now, I know he has an unconventional, or maybe a name that's hard to spell for some people. Always go to goldnewsletter.com/podcast for our show notes. Our amazing editor, Daniel Duarte, gets all the links up there. And Joe, I look forward to having you back on. So thanks for your time.
All right. Thank you very much.
Excellent, man. Cheers.